Continued buying interest on dips ensured that gold hung on to last night's record high today, despite the fact that the dollar went nowhere during the session. It seems the big bullion bet continues to attract popular interest, as CNBC's Scott Cohen now reports.
At the nation's largest gold producer, Newmont,
fire in the hole, Leo.
They keep on mining it.
Produce all you can as quickly as you can at the lowest cost you can is the formula.
The formula is working for Newmont. Its stock is up more than 60% this year thanks to the record price of gold. For CEO Richard O'Brien, life is good.
When you're in record territory, you can be nervous, you can be thankful. I can tell you I'm pretty joyous about it.
This is what makes it all worthwhile. This is a bar of 90% pure gold. It weighs about 70 pounds, and at today's prices, it's worth around $1.25 million.
And Richard O'Brien thinks it could go even higher, maybe to $1,300 an ounce next year, as the federal budget deficit continues to grow.
But with the printing presses on, people are anticipating inflation. That inflation will probably lead to higher gold price because it will lead to a weaker dollar.
But just this small amount could be worth up to $1,000.
Those commercials telling you to sell your gold, O'Brien says, beware.
I would say if you're going to sell it, there are lots of people out there who are thinking gold's a great investment, and you're probably going to get a fair price for it, but I think a year from now you're going to regret it.
Let's get some analysis. Peter Morchie joins us from the University of Maryland, former chief economist for the International Trade Commission. Rick Santelli is still with us from the NASDAQ, and Joe Livornia, who's joining us from Deutsche Bank. Harvard professor Niall Ferguson will be with us in a moment. I make no apologies for doing this. Let me go round, if I may, each of you in turn, and ask you your frank view on where we're likely to trade on gold and whether people should still buy in. Peter, if I may, let me kick off with you.
Oh, I think gold has got some more space to go up. There's a lack of confidence in the management of the U.S. economy, and the United States is printing too many bonds, which are as good as dollars, liquidity, driving down the value of the dollar against the euro, the yen, and everything else. Gold is going to continue rising. It could easily go above 1,300.
What happens if you suddenly get a move back on the dollar, or is that really not on the horizon for 2010 for you?
I don't think it's on the horizon. I think the Obama administration is doing nothing but generate a lack of confidence in the management of this economy. It's going to have $1 trillion plus deficits for the next 4 years. Healthcare is a disaster. No, I think that gold is going to stay strong.
Joe, do you agree?
I think gold will stay strong in the short term. 1,300 is actually probably not much of a move from how much we've gone up already. I would argue, though, if the economy turns out to be better next year, which is our view, and the Fed tightens and the dollar carry trade gets unwound, which I think is a very crowded trade, I think you will see a substantial correction in gold prices from higher levels than where we are right now.
Rick, I heard a suggestion from somebody in the market today that, and we've spoken about the way in which there's been this move, this flight to quality into the short end of the bond market, that arguably this might be people preparing for a rebound in the dollar because it's not a bad place to be.
You know, I think that the negative spiral that's going on between deficits, whether you're printing bonds or printing paper, I think all that creates an environment where I don't think the dollar is going to have any sustained upside. But it has been orderly, as mentioned in the minutes. I agree with that part of the minutes. But, you know, commodities can run on emotion. Just because it makes sense, so many traders have no avenue for the commodity to go down. Every permutation in their mind means higher gold prices. I understand the dynamic, but beware, commodities that go parabolic, even when they make such fundamental sense, when emotion takes over, strange things can happen. Be prepared for some wild moves, and if you're committed to gold, remember, if interest rates ever do start to go up, the negative carry at these levels could give you huge corrections ahead.
Joe, let me change the subject slightly, if I may, and talk specifically about China. Overnight, we had quite a big fall, over 7% fall in the dollar-denominated shares in Shanghai, after they'd risen about 26% on the month, on expectations that we might get a revaluation of the yuan, and arguably that hot money is beginning now to flood out, as it arguably can or can't within those relatively illiquid markets. I mean, what's your take on the China aspect to this?
I mean, China certainly is very important globally. They're a factor behind rising commodity prices, and certainly why a lot of other peripheral currencies have not had their currency depreciate because they're tied to the dollar. So, I mean, I think China is a factor. I think growth there will be strong. Whether they revalue, I don't know. I would hope so, but I don't think it's going to happen. I think we need more balanced growth, which means less exports from China, more domestic consumption. I honestly don't think it will happen.
Yeah, you say that. I mean, let me go over then to Peter. There is a symbiotic relationship going on here. You know, arguably each side needs the other, don't they? The Chinese need to buy the treasuries in order to ensure that America stays afloat, in order to ensure that we suck in what they produce.
Oh, I don't know that they have to buy the treasuries. As long as they buy dollars, if they shouldn't buy the treasuries, they're stuck with them. That takes them out of circulation. The Fed could turn around and print the same dollars again and buy up the treasuries. The only difference would be the Fed would get the interest instead of the People's Bank of China. More fundamentally, there has to be a recalibration of currencies. I think there's an expectation of some revaluation. It will not be of the order of magnitude necessary to correct the imbalances in the global economy. I'm expecting something like 5 to 10% when you really need something much more dramatic than that and sustained over time.
If I gave you $1,000 tonight to invest for your children in 5 years, where would you put it?
Oh, I'd put it in the U.S. stock market. I believe that one way or another we will find a way around this mess. If China doesn't revalue, we may end up doing it for them through some means like taxing dollar-yuan conversions, because at some point this situation will become intolerable. Once that happens, the U.S. economy will zoom.
Rick, I'll come to you in a moment. First, Joe, if I gave you $1,000, where would you put it?
I would agree with Peter. I think large cap equities make a lot of sense. They've got tremendous operating leverage. Nominal GDP has turned positive. Again, very simply, credit spreads have tightened back well through pre-Lehman levels. I am of the view that we'll get back to at least those levels for the S&P sometime in the next year. So you're looking at 1260, 1270. And I think beyond that, if you think there's sustainable recovery beyond next year.
Rick, are you prepared to make a judgment?
You know, I'd put it in the short end. I don't care how much or how little you get back from T-bills. I understand why stocks go up. I understand that the weak dollar shows up in that adjustment process, but I think the fundamentals don't back it. Hence, there's a vulnerability, and it's been a long run.
It's been good to talk to you all. Thank you. Rick Santelli, Joe Livornia, and Peter Morici. Stay where you are if you would.